Hey guys, welcome back to the Bitcoin Fortress podcast. This is episode 213. Today is April 26, 2026. We are sitting at block height 946772. Moscow time is 1278 sats per dollar, and fees are still beautifully boring at 1, 1, and 3 sats per VByte. That means the network is working exactly as designed. Blocks keep coming. Fees are reasonable. No committee meeting required. No Fed press conference required. No trusted third party required. And that ties perfectly into this week's featured Substack post, Bitcoin versus Monetary Trust, which we will talk about later on in the show. The theme this week is trust. Trust in central banks, trust in ETFs, trust in corporate Bitcoin treasuries, trust in politicians, trust in miners, trust in market structure, trust in monetary institutions that have spent the last century asking for more and more of it while deserving less and less of it. Bitcoin flips the model. It does not ask you to trust, it invites you to verify. So with that, let's jump into the news for April 19th through 26, 2026. First category up, institutional Bitcoin goes deeper. And our first story, BlackRock IBIT options open interest surpasses Deribit. This is one of the biggest structural stories of the week. CoinDesk reported that open interest in options tied to BlackRock's spot Bitcoin ETF, IBIT, surpassed Deribit. That matters because Deribit has long been the dominant venue for Bitcoin options. Now, a regulated US ETF product is becoming one of the major centers of Bitcoin derivatives activity. This is not just Wall Street likes Bitcoin, this is Bitcoin liquidity migrating into regulated financial plumbing. For years, the offshore crypto native exchanges were where price discovery happened. Now more of that activity is happening through ETFs, option chains, wealth management platforms, and institutional desks. That is bullish in one sense because it expands access, but Bitcoiners should also understand the trade-off. ETF Bitcoin is convenient, but it is not self-custody. Options exposure is liquid, but it is not sovereignty. Wall Street can financialize Bitcoin, but it cannot change the 21 million. Institutions can wrap Bitcoin in paper, leverage options and indexes. They certainly did that with gold, but they cannot print the underlying asset. And it's certainly never been easier to own Bitcoin in cold storage and in your own custody. Spot Bitcoin ETFs pull in about 2.1 billion over 8 straight days. CoinDesk reported that US spot Bitcoin ETFs logged 8 straight days of inflows totaling about $2.1 billion through April 23rd. That pushed cumulative flows higher after a rougher stretch earlier in the year. This is the ETF story becoming boring. And that's the story. The initial ETF launch was exciting. Then came the volatility, then came the outflows, but now we are seeing the more important phase, persistent allocation. This is how institutions move. They do not all ape into Bitcoin at once. They allocate, rebalance, model, committee, approve, and then slowly increase exposure. The short-term holder selling into ETF demand is also important. Coins are transferring from weak hands and shorter duration traders into longer duration vehicles. That is very Bitcoin. Volatility on the surface, structural adoption underneath. Investors Business Daily reported that Bitcoin outperformed gold in April, with Strategy's large purchases playing a major role in the move. Strategy has reportedly spent more than $1 billion a week in several recent weeks, while its financing machine continues to evolve. Strategy is now almost its own Bitcoin monetary institution. Michael Saylor's company has become a corporate Bitcoin accumulator, a capital markets experiment, and a live case study in whether fiat capital markets can be used to acquire the hardest money ever created. The bullish view, strategy is absorbing Bitcoin supply with long-term conviction. The cautionary view, the structure depends on market appetite for strategy equity and preferred securities. If those vehicles trade poorly, the machine slows down. But either way, the lesson is profound. Corporations are beginning to understand that cash is a melting ice cube. Strategy just happens to be the loudest and most aggressive example. Investopedia reported that Strategy wants to change the dividend payment frequency on its stretch preferred stock from monthly to semi-monthly while keeping the annual yield structure intact. The goal is to make the preferred shares more attractive and potentially reduce volatility. This is inside baseball, but it matters. Strategy is not just buying Bitcoin, it is trying to build a repeatable Bitcoin acquisition engine using corporate finance. The interesting question is whether this becomes a template. Could other companies issue preferred stock, convert fiat capital into Bitcoin, and slowly transform their balance sheets? Maybe, but Strategy has first mover credibility, a massive Bitcoin stack, and a CEO chairman team fully committed to the model. Copycats may not get the same market premium. The Bitcoin takeaway, capital markets are waking up to Bitcoin, but the safest, cleanest version remains simple. Earn fiat, buy Bitcoin, self-custody, and wait. Moving along to Bitcoin market structure and signals. Van Eck published its mid-April Bitcoin chain check, highlighting two historically bullish signals, negative funding rates and clustered hash rate drawdowns. Van Eck noted that 7-day Bitcoin funding rates turned negative to the lowest level since 2023, and that prior hash rate drawdown episodes were often followed by strong forward returns. This is a classic Bitcoin setup: bearish sentiment, miner stress, and strong underlying structure. Negative funding means traders are leaning short. Historically, that has been a contrarian signal. Hash rate drawdowns mean marginal miners are under pressure, but Bitcoin's difficulty adjustment is the magic. When weaker miners shut down, difficulty eventually adjusts, surviving miners get relief, and the network keeps producing blocks. Bitcoin doesn't care about anyone's balance sheet, it adjusts. That is why mining stress can look scary in the moment, but be healthy over time. MarketWatch reported that Bitcoin moved above 79,000 during the week as investors responded to easing Iran-related tensions, ETF inflows, and renewed risk appetite. This is the risk asset version of Bitcoin showing up. In the short term, Bitcoin still trades with liquidity, macro expectations, and geopolitical risk. When liquidity improves, Bitcoin often benefits. But long-term, Bitcoin is not just a risk asset, it is a monetary escape hatch. That distinction is important. Traders see Bitcoin as a high beta NASDAQ. Bitcoiners see it as incorruptible savings technology. Both can be true over different time horizons. Economic Times reported that Bitcoin climbed near 77,400 during the week as roughly 330 million in crypto liquidations hit the market. This is why leverage is dangerous. Bitcoin already has enough volatility. Adding leverage turns a volatile asset into a casino. For long-term Bitcoiners, liquidations are noise. They create dramatic candles, but they do not change the protocol, the supply cap, or the long-term thesis. The best Bitcoin strategy remains boring. Stack sats, hold your keys, keep your time horizon long. Moving right along to mining, energy, and infrastructure. American Bitcoin announced that it energized about 11,298 additional ASIC miners at its Drumheller site, adding about 3.05 exahash per second to its operational fleet. The company said its own fleet now totals about 89,242 miners, and 28.1 exahash per second. This is mining industrialization in real time. American Bitcoin is trying to combine mining with Bitcoin accumulation. That is different from miners that immediately sell most of their production to cover costs. The important question is, can miners become Bitcoin stackers again? In the early days, miners were natural Bitcoin holders. Over time, public miners became more like energy arbitrage businesses with heavy capex and debt. Now some are trying to return to the mine and hold model. That is bullish if done responsibly, but it also requires discipline because mining is brutally competitive, as we have all learned. Bitcoin.com reported that miners have outperformed Bitcoin in 2026 as companies like TeraWulf benefit from AI-related contracts. This is one of the most important mining themes right now. AI data centers and Bitcoin mining both want cheap power, large sites, and high-performance infrastructure. Some miners are realizing that AI customers may pay more stable revenue than Bitcoin mining. That creates a fascinating tension. On one hand, AI revenue can strengthen mining companies and help them survive bear markets. On the other hand, if too much mining infrastructure pivots away from Bitcoin, the industry changes character. Bitcoin does not need any one miner, but Bitcoiners should watch whether public miners are truly Bitcoin companies or just energy infrastructure companies using Bitcoin when convenient. And of course, the demands of the AI infrastructure are 24/7, 365, no downtime versus Bitcoin mining, which can easily shut down if needed to protect the grid. So quite different use cases there from the miner's perspective. Next up, regulation, politics, and monetary trust. The DOJ closed its criminal investigation into Fed Chair Jerome Powell. According to multiple outlets, Bitcoin Magazine framed the story as clearing a path for Kevin Warsh's confirmation process. This is not a Bitcoin story directly, but it is absolutely a monetary trust story. The Federal Reserve is supposed to be independent, but the more political pressure surrounds the Fed, the more obvious the problem becomes. Our monetary system depends on trust in people, committees, appointments, investigations, and institutional credibility. Bitcoin removes that entire layer. There's no Bitcoin chair, no Bitcoin board of governors, no emergency press conference, no political appointee deciding the supply schedule. Every Fed drama is a Bitcoin advertisement. Reports during April noted that the Senate timetable for the Clarity Act may be slipping, despite earlier optimism around digital asset market structure legislation. Regulatory clarity matters for exchanges, banks, ETFs, and institutions, but Bitcoin itself does not wait for Congress. That is one of the great misunderstandings. A law can affect companies that touch Bitcoin. It can affect custody providers, banks, exchanges, and ETF issuers, but it cannot change Bitcoin's issuance schedule or consensus rules. The regulatory perimeter may become clearer, but the protocol, it's already clear. CBOE published a notice that effective April 27th, it would activate complex AIM for options on the CBOE Bitcoin US ETF Index and Mini Bitcoin US ETF Index. Again, this is plumbing. Most people ignore market plumbing, but plumbing is where institutional adoption becomes real. Bitcoin ETFs were step 1, options are step 2, index products are step 3, structured products and model portfolios are next. The bullish point, Bitcoin becomes easier for large pools of capital to access. The Bitcoiner caution. Access is not ownership. A Bitcoin ETF option may be useful to traders, but it is several layers removed from holding your own keys. Stay humble and stack sats, folks, and hold your own keys. Next, let's jump into corporate and global adoption. Reports this month noted that Goldman Sachs filed for a Bitcoin premium income ETF using a covered call style strategy. This is another sign that Bitcoin is becoming a full financial asset class. First came spot ETFs, then options, now income-oriented Bitcoin products. That may attract investors who want yield-like exposure, but listeners should understand the trade-off. Covered call strategies can generate income, but they usually cap upside. And Bitcoin's upside, well, it's the whole point. For some investors, these products may fit a portfolio, but for a Bitcoiner with a long time horizon, selling away upside on the hardest asset in the world may be a mistake. Maybe a mistake. Is a mistake. Come on. Investors Business Daily reported that Bitcoin outperformed gold during April, with Bitcoin rising significantly while gold was roughly flat for the month. Gold is the old world answer to broken money. Bitcoin is the digital world answer. Gold has history, but Bitcoin has portability, divisibility, auditability, and a perfectly fixed supply. And you don't need a Brinks armored car to move it around or have to pay a custodian to store it in a safe for you and trust them and pay insurance. You could do that all in the privacy of your own home. The key distinction, gold is scarce but not perfectly scarce. Bitcoin is perfectly scarce. Gold is hard to move. Bitcoin can move across the world in minutes. Gold is difficult to verify. Bitcoin can be verified by anyone running a node. Gold is analog trust. Bitcoin is digital verification. Bitcoin Magazine noted that Bitcoin 2026 takes place April 27th through 29th at the Venetian in Las Vegas, with major Bitcoin speakers and builders expected. And I'm sure we'll have a few things to talk about next week about the conference. Of course, worth mentioning because conferences are where narratives form. The ETF era, corporate treasury era, mining energy AI era, and the sovereign reserve era are all converging. But the most important people at a Bitcoin conference are not always the famous speakers. They're the builders, educators, node runners, wallet developers, privacy advocates, miners, and ordinary stackers. Bitcoin is not just a price chart, it is a movement of people opting out of broken money. For my own part, it's kind of expensive to go to a conference. I used to go to the one they had up in LA that was sponsored by Swan. That was relatively cheap, relatively easy to get to, and small and intimate, and had good speakers. But the best part of going to the conference, well, the speakers are interesting, but the best part is the meeting other Bitcoiners and just connecting, and just understanding that there's so many different people that are involved in Bitcoin from all different backgrounds, walks of life, ages, and it's just nice to connect with those folks. So if you haven't been to a conference, it's worth going. And maybe some of the smaller conferences are better if you don't like huge crowds. And I'm not sure about Las Vegas as being the right venue for the Bitcoin conference, but it is what it is. Maybe Miami or Nashville are better, but anyway, worth checking out if you haven't been to one. Moving right along to the Bitcoin podcast universe, themes of the week. The first theme, Satoshi's coins and social pressure on Bitcoin. So what Bitcoin did, released an episode titled Should Satoshi's Coins Be Frozen with Rob Hamilton on April 21st. This is the perfect example of why Bitcoin must resist social layer capture. The moment people say we should freeze those coins, they are importing fiat thinking into Bitcoin. Bitcoin's neutrality is not a bug, it's the entire point. Theme 2, Bitcoin and energy demand. What Bitcoin did also released AI is Coming for Bitcoin's Energy with Michael Dunworth on April 23rd. AI and Bitcoin are now competing for the same scarce resource, reliable energy. That makes Bitcoin mining more politically relevant, not less. Mining is becoming part of the energy conversation, the grid conversation, and the national infrastructure conversation. Theme 3, Bitcoin conferences and global community. Stefan Livera's latest episode covers BTC Prague 2026 with Matthias Kuchar. Bitcoin conferences matter because Bitcoin is global, but adoption is local. Prague, Las Vegas, Nashville, El Salvador, Madeira, each community becomes a node in the human network. And finally, theme 4, Bitcoin power law discussion continues. Stefan Livera also recently featured Giovanni Santostasi on the physics of Bitcoin and power law analysis. The power law conversation is interesting because it attempts to describe Bitcoin adoption as a natural growth phenomena. I would treat it as a model, not a prophecy, but the broader idea is powerful. Bitcoin adoption may look chaotic up close and surprisingly orderly over longer periods. Featured Substack post of the week, as I mentioned earlier, is called Bitcoin versus Monetary Trust. This post fits perfectly with the week's news, the Fed story about trust in central bankers, the ETF story about trust in custodians. The strategy story is about trust in corporate capital structures. The mining story is about trust in energy economics, and the regulation story is about trust in lawmakers. Bitcoin says, stop trusting, start verifying. That's why running a node matters. That's why self-custody matters, and that's why the 21 million supply cap matters. Bitcoin replaces institutional trust with personal verification if you use it properly. Before we wrap up, a quick reminder, I have 3 Bitcoin Fortress books available, links in the show notes. Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners, Bitcoin Retirement and Estate Planning, and the Bitcoin Lifestyle. And I'm also working on the next book now, which will build on a 12-week Substack arc that I've been working on around Bitcoin versus the broken fiat system. So hopefully we'll have that out here in the next week or two. So stay tuned for that. Should be interesting. The goal is simple, make Bitcoin understandable, practical, and deeply connected to the world people are actually living in. Well, folks, that is it for episode 213. This week's theme is trust. Trust in the Fed is fragile. Trust in politicians, conditional. Trust in financial institutions is outsourced. Trust in corporate balance sheets is risky. Trust in fiat money is fading. Bitcoin offers something different. Not perfect people, not perfect institutions, not perfect forecasts, and not perfect markets. Just a perfect supply cap enforced by code, verified by nodes, protected by miners, and chosen freely by millions of people around the world. Stay humble, stack sats, run your node, hold your keys, and thanks for listening to the Bitcoin Fortress podcast. I will talk to y'all next week. Bye-bye.